Our next revision topic is capital allowances, another very important topic. So, what is capital allowance? It is said to be business tax relief and it is available on the purchase of qualifying asset like plant and machinery. It is allowed on the original cost plus improvement. Capital allowances are calculated for trader's period of account. Capital allowances are allowed on plant and machinery that perform active function. Means asset with which the business is carried on, not the setting in which the business is carried on. Now this is the performer for the sole trader and the partnership. It has different columns. First and the main important column is main pool, then special rate pool, short life asset, private use asset, and the last one is capital allowance. We will discuss all the detail of these columns and the allowances rules in detail. So start with the main pool. The main pool includes most plant and machinery, new car which has a CO2 emission of 1 gram per kilometer to 50 gram per kilometer, while used car with CO2 emission up to 50 gram per kilometer. Means used car with zero CO2 emission will also be included in the main pool. It excludes new car with zero CO2 emission or new and used car with CO2 emission more than 50 gram per kilometer. Short life assets, assets dealt with in special rate pool and assets with private use by trader. So first type of allowance is known to be annual investment allowance. 100% allowances on first 10 lakh expenditure incurred by the business. Remember, this 10 lakh amount is for 12-month period of account. So it is adjusted for different period of account. For example, if a trader's period of account is 15 months, then in that case, the allowance would be 10 lakh multiplied by 15 divided by 12. And if he has a period of account of 4 months, you have to multiply 10 lakh by 4 and divide by 12. So this is how you have to adjust the annual investment allowance on the basis of period of account. Second point, this is not available on cars. Third, not available in the final period of trade. Unused annual investment allowance cannot be carried forward or cannot be carried back. Second type of allowance is first year allowance, which is 100% allowance available on the purchase of new car with CO2 emission 0. It is never time apportioned, not allowed in the final year of trade. Next type of allowance is return on allowance. Annual return on allowance is 18%, is given on the reducing balance. Means whatever is the reducing balance available in the main pool, it will be recorded on that. It is also time apportioned and again on the basis of period of account, just like AIA. It is given on total written down value plus addition not qualify for AIA and FIA less disposal. And also it is not provided in the final year of trade. WDI is not restricted due to length of ownership in the period of account. Means it doesn't matter when you have purchased that asset. It is a portion on the basis of period of account, not your ownership. If you have purchased an asset in the mid of the year, it would not reduced. Disposal. As we have considered here that WDA is available on the opening total return on value plus addition not qualify for AIA and FIA. AIA means annual investment allowance, FIA first year allowance, less disposal. Now disposal, when an asset is disposed, the disposal value, which could be original cost or sale proceed. In fact, whichever is lower is said to be the disposal value. That disposal value is deducted from the main pool. Now, what if the sale proceed exceed the original cost? Excess is said to be taxed in fact as chargeable gain. Now, what is balancing charge? In case of balancing charge, you have to compare the sale proceed with the balance brought forward, and if the sale proceed is greater than balance brought forward, it is known as negative capital allowance. Treatment of balancing charge or negative capital allowance: when there is no capital allowance available, to deduct that negative capital allowance from this, you have to increase taxable profit. Means if there is no written down value, neither you have purchased an asset, and so there is no capital allowance available. So negative capital allowance in that case would directly increase the taxable profit. Balancing allowance: it is said to be excess of pool balance over the sale proceed in the final period. Business can claim relief for that. Small balance in main pool: where unrelieved expenditure are 1000 or less, the balance can be claimed as allowance, and leaving relevant pool with a nil balance. Assets with the private use by owner. Remember, owner's private use matter here, not the employee's private use. Only the business proportion attract capital allowance. Special rate pool: for special rate pool expenditure, written down allowance rate is 6%. What asset are considered as special rate pool or to be recorded in the special rate pool column? First, it is long life asset. Long life asset is said to be an asset which has a cost of at least 1 lakh and life of 25 years. High emission cars means those cars with a CO2 emission more than 50 grams per kilometer. Integral features: electric and lighting system, cold water system, space or water heating system, powered system for ventilation, cooling or air purification, lift or escalator, and thermal insulation. Now remember, very important thing is the order of allocation of annual investment allowance. If you have special rate pool as well as main pool, then you have to allocate annual investment allowance first to special rate pool and then to main pool. And if you have more than that, means you have special rate pool, you have main pool, short life asset and private use asset as well. In that case, the order of allocation of AIA would be first to special rate pool, then to main pool, and the third number short life assets, and the fourth one is the private use asset. Small pool WDA, where the balance both in main pool and special rate pool before the calculation of WDA is up to 1000, the balance can be claimed as WDA. Short life assets: assets with expected life of less than 8 years, recorded in a separate column. On sale within 8 years, separate balancing allowance or charges arises. What if asset is not sold within 8 years after selection as short life asset? It would be transferred again to the main pool. Whatever is the written down value would be transferred to the main pool. VAT, value added tax: if the value added tax is irrecoverable, capital allowances are claimed on VAT inclusive price. VAT is irrecoverable on cars that are not used 100% for business purpose. Recoverable VAT: capital allowances are claimed on net price, means price excluding VAT. Structure and building allowances: it is 3% on pro rata basis on qualifying expenditure like building, office, warehouse, factories, and it is allowed on the original cost plus subsequent improvements. Also, structure, road, walls, bridges and tunnels are said to be qualifying expenditures. But land, legal fee, repairs and maintenance are not qualifying assets. This is statutory understanding 4, in which there is a negative capital allowance available, and the treatment of negative capital allowance both in case we have some capital allowance and we don't have some capital allowance. Statutory understanding 8, where application of the order of annual investment allowance is given in this question, plus another car which qualify for special rate pool and also used for private purpose is given in this question. So very important as your understanding. So need careful consideration.